really are a no-brainer. There is no downside. Everyone has something to gain and nothing to lose. It's very rare that the taxman gives you something where you can retain 90% of any gain, not doing much more than your day job. The most common is the EMI scheme, which stands for Enterprise Management Incentive Scheme. Over 11,000 companies have put one in place, so you're in good company. They're well understood, very flexible and accepted in the market. They do deliver the best tax outcome. However, there is a qualifying criteria for an EMI scheme, and some companies and participants do not meet the requirements. If a company does not qualify for an EMI scheme, then unapproved options can be granted using growth shares. The key point here is that you issue shares to an employee, and when they're issued, because their share return are deemed to be of no value. Therefore, they can be issued at a low price and trigger no tax liability for the employee or company. Another share scheme is a CSOP scheme, which stands for Company Share Option Plan. These are another route for larger companies. If none of those work, you can try an unapproved share option scheme, which are not in any way as tax efficient but possible. There are three main reasons. Fairness. No one single-handedly grows a business, it's a team effort. Secondly, to attract and retain the key players and to engage them to deliver value in the long term. Thirdly, if people have worked hard and you have more cash to go around, why not give them a slice of what they've worked hard to achieve? In my experience, I've commonly seen buyers suggest that when there are no options, a seller has to give the employees an exit bonus and make this a deal requirement. If this applies, you're going to end up giving more away because of the amount of tax you're going to have to pay, and it will cost you more. On an exit, the employees pay as little as 10% tax on the gain, less than normal capital gains tax allowance, so nets to nothing, rather than PAYE, national insurance on any bonus. For growth shares, we can secure the normal capital gains tax rate. It's also possible for the company to get a corporation tax deduction for the exercise price on any option, again reducing the net cost. The common theme is that tax is much lower than basically waiting for an exit and then giving people a bonus, or being required to pay them a bonus. You can, but to give 50p to an employee it will cost you, out of the sale proceeds, up to £1 because of tax. There's 45% income tax and both employers and employees' national insurance. So for example, if you had in mind to give a key member of staff £100,000 net, they need to be paid by you about £180,000. However, under an option to give someone £100,000, it will only cost £110,000. You'd make the option only exercisable on an exit, so if you sell, then they can exercise and achieve some value. Separately, you can link it to EBITDA. The higher the exit value, the more options that can be exercised. You can link it to the long-term service. Longer people stay, more options can be exercised. And you can link it primarily to long-term value and the objectives that you have set to deliver. We can explain which scheme works for you and your business. We can point you towards tax advice and other professionals can help on the scheme. We've done this plenty of times and we can guide you through the process and tell you based on your objectives what we believe is the right approach and how we can structure the scheme.